is August 11th, and this is of course English. And this is of course the video log that takes 30,000 to a million. And today I'm going to talk about a really pro topic, which is how to minimize your risk using option strategies. And that's really pro because normally people associate options with really risky bets, right? Like buying call options or buying put options where you're throwing around a few $100 in hopes to winning 1,000 if things go your way, and you have this like exponential reward concept, and things are really crazy looking. But options can be the safest, and it can be the riskiest thing you do. It just depends how you use the options, the combinations of options, right? So first I'm going to show you the account and some of the positions and where I'm sitting at, which is close to an all-time high, I think. And after I show you the positions, I'm going to run you through what you can do to protect, minimize risk of like large stock positions. Obviously large is relative, but some of these protection strategies can be kind of expensive, or not expensive, but difficult to pull off because you need 100 shares of something, right? So let me go into the account and I'm gonna show you the what's going on here with these positions. All right. So I'm sitting at 114,306. It's probably the largest number that you've seen on the stream on the videos here, in the video log. And I currently have about 63 options contracts, which is kind of crazy, but 62 of them are sells. I've sold these contracts, so I'm just collecting premium. And which is kind of nice because with this many contracts running, basically, let's say the average contract devalues by like $0.50 a day, then I'm making about $31 a day just by having these contracts open. I mean, it's like a full-time job where I work an extra hour a day or something. If you're getting paid $30 an hour, let's say, which is cool. So let's see. As always, you can pause the video at any moment and try to figure out what exactly my position represents. This is the symbol, the ticker. Then I have the price, whether it's call or put, the expiration date of the option contract, the number, how many contracts, and whether it's a sell or a buy. So you can gather all relevant information just by looking at this stuff here. And I'm just going to scroll quickly through it. You can pause at any moment and check it out. And I usually hold contracts for about a month on average, sometimes longer, sometimes shorter, but mostly a little bit like around a month, I'd say, is the average holding period. Some of them are really long, like you can see some of these are all the way out to January 15th next year. 5 of these contracts of Energy Fuels. And this is my only buy, which is the Apple 300 call, which I haven't actually sold yet. And I don't know if I will. I might just hold it till next year, 2021. We'll see how it goes. Although Apple's had a hell of a run, seriously. So here are my actual positions, which means my equity, my holdings. I have here 75 shares of Apple. You can see the symbol here, the number of shares below, and you can deduct all relevant information if you want to know about my positions. Here they are. Click pause at any time. That's it. All right. Now, it was a kind of a mixed bag today. Apple carried the day a little bit, so I was about up maybe $1,400. But about a neutral day, if you count out Apple, right? Okay, so that's it with the account. If you want to see the account tab, this is the account tab right here. It's cool to look at, like I always say, but it's not really that informative because of the options that are running. They kind of skew everything. So biggest equity positions: Apple, Chemical, Realty Income, Energy Fuels, DEM, Wisdom Emerging Markets, Dividend Fund, SBRA, which I have call options sold against them, so it might go away, Visa, etc. Biggest gainers: Apple, Wheaton Precious Metals with a 1500 gains, about 100% gain there. Cameco, etc. Realty Income. All right, now let's talk about. Oh, I hate when it does this. So, well, it's gonna change as soon as I click on Apple to try to do option strategy, anyways. But so let's talk about the how you can kind of basically pull insurance for a large stock position that you might have. Okay, and you can do this for almost for free, or kind of for free, and protect yourself against downside. But it does come at a cost, except it's not necessarily a monetary cost. It could be the forfeit of future gains. All right, so you know it's going to involve selling a call. Okay, let me show you what I'm talking about here. It's a really nifty trick. Okay, so what you do is, let's say you have 100 shares of a very valuable stock, for example Apple, or even Ford. You can do it with any stock as long as you have 100 shares. Then what you want to do is you go into the market, you sell a call against them, and then what you do is you go on the same date and you buy a put at equivalent price. So that way you get the insurance for free, although you surrender any future gains from that call price, strike price. So let me show you what that looks like. It's a really professional move, and a lot of hedge funds and stuff like that do this kind of maneuver, and it's pretty attractive, but you know, it might be so safe that it suffocates some of your gains. So let's take Apple for example. Let's pretend that I have 100 shares of Apple. Currently I have 75. I would go and click trade options. The phone interface actually looks a lot like this one. So if you're trading on the phone, you can follow along. Then what you want to do is you want to sell a call. So let's say, for example, that you want to pick a date always whenever you're doing any kind of options play. So let's say I want to protect this 100 share, quote unquote, until December 18th. All right. So I'm going to sell a call, let's say at the 500 price range. So that will give me a $2,230 credit. Maybe I should do that. And then what I'm going to do is I'm going to buy a put on the same date, December 18th. I'm going to look for a $2,200 price. Okay, so here's one, the 410 put. Boom. Okay, there we go. I've done it. So I'm actually going to get paid $45 for doing this trade, right? So I'm getting paid to insure my 100 shares of Apple. All right, so here I am. Click continue. Contracts 1. Okay, there we go. Good for the day. Review order. It's probably going to give me some okay, so it wants me to enter a limit. I'm not going to keep going with it, but you enter the limit price that you want, and then it's going to, if you don't have sufficient amount of funds or you know, collateral, then it's going to ask you for that. But you just review it and you execute the trade, and then you're set. Okay, you have this thing, you've received your $45, and now what's going to happen is if Apple goes above $500 by December 18th, then you will have to sell your position. Your put will expire worthless. Okay, and you get the cash, which is going to be like $50,000 in your account. And you don't have to do it Apple. Like I said, you can. Maybe I should do it Ford. Let's do another example with Ford, okay? Because it's a cheap stock and it's a very popular stock, and I think it's popular because it is cheap, and it's a well-known company, and I think a lot of Robinhood people like to do options on it. Okay, so here we go. Let's pretend I have 100 shares of Ford. I'm gonna pull out. Let's say I want to protect it against. I'm gonna insure it on until at a date of December 18th. And so I'm going to sell a call, let's say a $9 call, boom. And then I'm going to buy a put at the same date, so I got $23 to spend. All right, there we go. So I'm gonna do, well, let's do a $6 here. So this might cost me a little bit because I'm gonna be losing a little bit of money here, right? So total cost $16. $6. Well, let's say $5. Okay, so I can receive some credit, just like the Apple example. So here we go. Right? Whoops. You enter the number of contracts, review, and it says I don't have enough shares for Ford. So it tells me, just like I said, you need the collateral required, which is going to be 100 shares of the underlying, equity. So you're gonna get paid $6. And the beautiful thing about this, right? The beauty of this is that whenever Ford decides to drop, not only does my call liability get erased, so I get that whatever $23 or something for free, but also my put appreciates in value. All right, so even though I'm losing value on the stock itself, my put's gonna gain in value a little bit, right? Or maybe a lot if the stock drops really quickly. And so now both of my options, right? Both of my options are gaining. I'm gaining value from both my options while I'm losing value from my stock. And then at some point after a big dip, I can just reverse that, right? I can just get the money, take the money out of my options. I can sell them, or I can buy back the call and I can sell my put. And now I have cash and I can reinvest it and get more stock if I want to, right? Or I can just keep them going until the expiration date, at which point I would just re-roll at the appropriate price, right? So let's say Ford drops all the way down, which is probably not going to be a smart thing to do, because at this point, if Ford is about $5, then both of your options are going to be worthless, and you're only going to get $23 for $700 worth of equity, which is now $500. So you haven't even covered like 12% of the losses, right? So you want to probably sell the put as soon as there's a big spike down, because options are depreciating assets, and so you want to get rid of them as soon as you can. All right. And so that's how you protect it. This is a really, really professional move, and you guys can try it. Feel free. I haven't actually done this, but I probably should now that my position is starting to get larger. You can do it, like I said, with small positions, but it really doesn't make much sense unless you have something big to protect it and you want to reduce the risk premium, right? If it's a lot of money that you don't want to lose, and of course a lot is always a relative term, then you can try this strategy. And it stunts your growth potential, potential a little bit, but it gives you a really nice downside protection, and it dampens volatility quite a bit in your account. So I hope you all use it. Let me know if some of you actually already use this strategy. And what are your findings, and what's your experience like when you use it? I'm curious to know. All right, I think I'm gonna wrap it up right here. It's been a pleasure. This is pretty cool stuff. So probably make another video on Thursday. Hopefully you all are making money more than, I butcher that, but I don't do retakes or edits. So hopefully you are making more money than I am. All right, peace out.